even the Federal Reserve, who manages our economy's money supply, they have a stated intent to have the cost of living, the inflation rate, increase at least 2% per year. Make no mistake about it, inflation causes things to become more expensive. Hello, everybody. It's John Llodra. I'm a co-founder and partner here at New Harbor Financial Group. I'm glad you're with me here today. We use these weekly videos to give our clients and viewers some data insight, and really with the purpose of helping to educate and make folks' financial lives less stressful and hopefully more secure. Usually during these weekly videos, we dive down into kind of short-term data on markets and kind of current events, if you will. What I'd like to do today is zoom out a little bit and really focus on one of the key important questions our clients ask themselves and turn to us to help them address, and that is their long-term retirement security. After all, most folks work and save and sacrifice so that they someday can retire and hopefully live off their savings very comfortably and without stress. And I like to say that our clients and folks don't retire for a month or 3 months or a year or 5 years. We hope and our clients should plan for a very long and hopefully fruitful and fulfilling retirement period. This requires us to really take a step back and help clients put things into perspective, not just in terms of investing and investment plans, but also their own lifestyle and what's important to them. Would like to cover that today. I'm going to cover a question of how much do I need to retire, how to go about even answering that question. And then I'd like to cover some common risks and pitfalls that folks will oftentimes run into, sometimes unwittingly, and oftentimes the result of psychological biases or fears or whatnot. Hope you find this useful, and I would certainly encourage you, if you do, to share this with your friends and family. Again, our hope here is to educate as many people as possible on these important matters. So let's dive right in. So the question of how much do I need to retire? Well, the first step that one should really answer is, how much are they going to need to spend during retirement? What is their lifestyle going to look like? Oftentimes, when someone retires, there's a change in lifestyle. So maybe a good place to start in estimating how much they're going to need to spend or live on is looking at their current situation while they're still working. What is their total income and what is their total outlay? And that maybe is a good place to start. But oftentimes lifestyle changes occur. Perhaps more travel is in the future during retirement. Eventually, one of the key real hot buttons for expenses is healthcare expenses. We all know that healthcare expenses are rising every year relentlessly, and certainly as one gets older, the expectation should be that those expenses are going to be a bigger part of the picture. That's a whole separate conversation in terms of how to go and estimate what is a reasonable expectation of your expenses. But it should start with a real intentional talk about lifestyle. What are your goals, your hopes, your dreams, and all that kind of stuff, and putting pen to paper, so to speak, and estimating those costs. Okay, and once you have that pinned down, it really comes down to assessing what kind of income might you have to go towards those needs. And of course, you hope that income is sufficient, not just for a short period of time, but for the full duration of your life. Not much worse than running out of money prematurely during your lifetime. And that's something that a good investment plan and financial plan can hopefully help protect against. But for most people, the first place to start in assessing income is to look at what we might call guaranteed sources of income. Many people that work either have Social Security or a pension, and perhaps both. So these are so-called guaranteed forms of income. They're guaranteed by the Social Security Administration or the corporate pension, or perhaps you're a teacher and or a state employee and there's a state or government pension. Now, I say guaranteed in air quotes because certainly with Social Security and even corporate pensions and state pensions, there are risks here, and I'll talk about those a bit later. But I don't want to alarm folks, but there are definitely risks that one should be aware of there, as to, hey, maybe they're not quite as guaranteed as we thought they were. You can add in to that passive income you might expect. Perhaps you have a rental property, and so long as the tenancy of that property is solid and countable. So you take your total living expenses, a projection of that, and subtract from that the so-called guaranteed or passive forms of income. And the shortfall there is the amount you're going to need to generate from your nest egg, your savings, be it IRA accounts, 401k accounts, or brokerage accounts, or bank accounts. This is the nest egg, so to speak, that you will need to use to create your own paycheck, if you will, during retirement. We like to call it a play check because hopefully it allows you to do the things you really want to do. So that shortfall has got to come from your nest egg. That speaks to the second step in the process. How much do you need to have saved? And here, again, there's a lot of variables here, but I'm going to try to distill a couple of, you might even call them rules of thumb. And throughout the talk here, Tim, I'm going to kind of poke some holes at these rules of thumb that can be useful, but there are all kinds of caveats. One way to think about this is how much can you safely withdraw from this nest egg without there being a high probability of running out of money during your lifetime? Now, there are a lot of variables, future investment returns, ups and downs, spending needs being coming out of nowhere, that you didn't anticipate. There's a lot of vagaries, a lot of uncertainties, especially if you're looking at a 30, 40 plus year retirement period, which we hope for our clients they can think about. What is the sustainable withdrawal rate? One of the big risks that we'll talk about is spending too much too soon. Okay. So there are some rules of thumbs out there. We use them, but we always caveat them. So there's the notorious 4% rule. And this is basically a rule that says, if you have a nest egg, you can plan to withdraw for a normal retirement age, 4% of that per year and adjust that upward for inflation. And that should give you a pretty low probability of running out of money. I'm going to talk more about that. Now, of course, that assumes a certain return projection. What we know from actual experience is that returns in markets are quite volatile. There are years where markets can be up big and they can be down big. And this has given rise to modifications of that, and I might call it just the adjustable rule, maybe using 4% as the base rule, but in years where returns are much higher than expected, perhaps you can give yourself a raise, call it 5 or 6% or something like that instead of 4%. But then you also have to account for years that are down. And this really speaks to investment risk that we'll get into later. All right, so this table is put together by Morningstar, and this is as of September 30th. And this is not meant to be a guarantee, it's just illustrative. Proper financial plan can help address some of these things. But what it shows is a so-called safe withdrawal rate over, as a function of weighting of equities or stocks and over a horizon of different years. Okay, so for example, you can see couple things. The longer the period of your retirement, 10 versus 40 years, you can see the safe withdrawal rate is in this case below 4%. It's in the 3% range. If you have a short period of time, of course, you have fewer years to have to fund your retirement, and you can withdraw at a much higher rate. And so that's pretty much a no-brainer, but I think it might be helpful for folks to see on paper here. So the longer the period, generally the lower the withdrawal rate, because you have to allow for a lot of uncertainty. Shorter the period, the higher the withdrawal rate you can likely safely do. One thing I want to tease out in this chart is you'll notice that the weightings of stocks goes from 100 to 0. And what you notice here for most of, especially of these normal kind of periods, 25, 30, 35 years, you'll notice that the maximum safe withdrawal rate kind of clumps around this area here, which is about a 30 to 60% equity weighting. Now, that's really important because it speaks to taking too much risk, even though the returns might be higher on average by taking over a long period of time, by taking all stock risk. It introduces volatility that can be very unhelpful during a retirement period. And I'll get to this in terms of drawdown risk and whatnot. So this speaks to a simple rule that sometimes it's better to get a lower rate of return if there's lower volatility than a higher rate of return. And that's really important because folks, when they get caught up in the short term, they think about, oh, I got to maximize my return. Really important to understand that. Lower volatility, that's really what our style here at New Harbor is meant to do, is to mitigate and lessen volatility and certainly mitigate downside risk. I'm going to kind of get into some of the key risks here. I already alluded to one of the key risks as being drawdown risk, and we'd like to call it sequence of return risk. And simply what this is in a nutshell, It comes down to luck. Some folks may just be at retirement age at a very unlucky time, given where markets are. Okay, there are times in the markets where good returns are likely to be had, and there are times, like we think right now here in the end of February of 2024, that the return picture looks very, very challenging from current levels. There will be a much better picture, we think, in due time, but from right here and now, we think the long-term return picture looks very, very challenging. So this shows a hypothetical starting nest egg of $1 million. And it shows a starting period of 1982, which happened to be a period when stock market valuations, as measured by the Shiller PE ratio, were very low at 7. The long-term average is closer to 16. You see here the average return over that period, this is a 15-year period or so, was 13.3%. And you can see even after taking, in this case, a 5% increase for inflation, the ending value of the nest egg continues to grow. If you instead look at a period of someone who was unlucky enough to retire in the year 2000, right at the peak of the tech bubble, which frankly, right now valuations are on some metrics very much on par with the tech bubble, you can see that there were some negative returns right out of the gates, and the average return over that same length of time was only 4.1%. And you can see in this case, the nest egg runs out of money. Now that really speaks to a really important point that valuations are a key determinant. So the unlucky pattern of returns has a lot to do with valuations, not just randomness, but valuations. And that's a key point in a very sound investment strategy should take that into account, because the economics of loss are very unforgiving. If you lose 10%, you only need 11% to get back to even. On the other hand, if you lose 50%, you need a full 100% subsequent return to get back to even. Really can't emphasize that enough, the importance of mitigating or lessening drawdown. The next risk I'd like to talk about is inflation risk. A couple weeks ago, I did a video exactly on inflation. If you look back on our YouTube channel, and again, I remind folks to follow and subscribe, because you'll get alerted to these new videos coming out all the time. But I talked about inflation. Basically, even the Federal Reserve, who manages our economy's money supply, they have a stated intent to have the cost of living, the inflation rate, increase at least 2% per year. Make no mistake about it, inflation causes things to become more expensive. So you need to account for that in your retirement. So it's not enough to say, hey, I need $100,000 a year to live on in retirement today. Well, you need to adjust it upward for inflation. So maybe 15 years from now, that's 160,000 or something like that. Really important to factor that into your planning. In that video I just referenced, I talked about, investing. If you look at the 70s, for example, which was a very pronounced inflationary period, some really surprising things maybe shake out for people. First of all, traditional investment assets, stocks and bonds, did horribly. They not only did bad in nominal returns, just the headline kind of returns that you see on your statements, but when adjusted for inflation, they actually lost money on what we call a real basis. Things that did well in the 1970s were things like commodities, energy, base commodities, precious metals. These are the kind real assets, if you will. Even real estate did well during the 1970s because they were a real asset. Fast forwarding to the most recent bout with inflation, we had a very pronounced spike in 2021 through the middle of 2022. Still debatable whether we've won the battle on inflation, but surprisingly, cash was one of the best places to be during that period. And not surprising to us, but for most folks, they've been trained to think that cash is the worst place to be during inflation. Sometimes, as for example, a recent episode in 2021 and 2022 will test, being in things like stocks and bonds can be a very bad place to be. They lost money over that time frame. Even things like Treasury inflation protected bonds, which are meant specifically to hedge inflation, can lose value, and they did in that period most recently because the bond market was very overvalued. So I'd like to share a chart here, a projection of different asset classes by Grantham, Mayo, Van Otterloo, GMO for short. This is a Boston-based institutional investment manager. Jeremy Grantham is one of the namesake founders, a legend in investing. And this is their 7-year asset class forecast. They put it out every month, and they update it every month. This was as of January 31st of 2024. And this shows their projection over the next 7 years, annual real returns What you'll see here is they have a decidedly negative real return forecast for US stocks, both large and small. That means they project, and their track record in the big scheme of things is very, very good, that you're going to lose money on an inflation adjusted basis over the next 7 years in US stocks, much more favorably looking at foreign stocks. And why is that? Valuations for US stocks are obscene. Valuations for foreign, especially emerging markets, are much more compelling. That matters. Not surprising to us, but surprising to conventional wisdom. They project that even cash is likely to do better on a real return basis than many forms of bonds, international bonds, and on pars with bonds, and even better than US stocks. So I want to share that just to set the tone and the context for it's not always conventional wisdom as to how best to invest for inflation. The next risk I'd like to talk about is asset allocation risk. And quite simply, this speaks to both investing too conservatively. If you go back to that Morningstar chart I showed you about the safe withdrawal rates for different levels of equity allocations, the sweet spot, at least in that chart, was somewhere in the 30 to 60% equity allocation. So in other words, 0% equity allocation is probably, if you held that over your full retirement period, going to come up woefully short of being able to fund your retirement goals. You need some growth in the form of equities, but it's got to be at the right times. Same token, investing too aggressively, especially when valuations are obscenely high, like they are now, like they were in 2000. That can be the death knell to an otherwise sound retirement plan. A while back, I did a video highlighting a paper that Vanguard put out this past fall, the fall of 2023. And it was surprising for many because Vanguard has long been the sage oracle of the merits of passive index investing. And it's a great way to invest for a lot of people, especially if you've got a very long time horizon. But even Vanguard in that paper, and I invite folks to go back and watch that video and read the paper that I referenced. Even Vanguard raises the caution that having a static allocation in the face of variable valuations can actually leave investors and folks who need to withdraw funds in a bind. So in other words, when valuations are high, invest more conservatively. And when valuations are low, you can invest more aggressively because the returns are likely to be there. So I'd like to segue into some common pitfalls. These are not so much market risk, but behavioral pitfalls that we see and have learned from and want to help counsel our clients. So first is chasing yield. When people enter a retirement mode, they all of a sudden start to think, I need income. I need income because I want to get my paycheck, so to speak, every month. And that oftentimes causes folks to chase investments that promise higher yields. Well, the problem with that is typically higher yields usually means more risk. So for example, think about junk bonds. These are bonds issued by companies that are not very creditworthy and have a decent probability of going bankrupt. Yeah, they pay higher yields. And frankly, right now, the yields are actually quite low historically to what they usually command. So that's another danger. But chasing higher yields oftentimes means taking on more risk. And what good is a higher yield if the capital value of the investment you're in drops and wipes out many years worth of those yields? And there's oftentimes more than meets the eye on yields. So for example, many closed-end funds, which oftentimes tout very high dividend yields, they use leverage, which can be great to magnify yields, but it can also create magnified downside in the event of interest rate moves, things like that. And many investments actually disguise, if you will, high yields in the fact that you're actually getting a portion of your own money back. So if you invest in, oftentimes, for example, oil and gas investments that return capital through depreciation to investors, you may get a high yield, but a good portion of that yield is just simply you getting your money back. So that's a whole nother topic to discuss there, but I just want to flag that. So chasing yield can be a real trap that you want to avoid. Great to have some yield, and especially if it's valued properly. It's a great way to grow and sustain a retirement program, but just don't chase yield at the expense of everything else. The other psychological trapping is investing for what you need versus what the market can give. And this gets another way of saying don't invest overly aggressively when the market is not likely to return and reward you for that. The fact of the matter, cold fact of the matter, is the market could care less what any one of us needs. And in fact, I might even say the market is primed to dupe us to do the wrong things at the wrong time. And just understand that you cannot squeeze blood from a stone, I think is the saying, and the market is no exception to that. The next one is, ironically, one of the pitfalls during retirement is folks not spending enough. They have amassed and saved a sufficient nest egg, and their own fear about running out of money, I would say oftentimes irrational fear, can keep them from spending and living the kind of life that they otherwise would like to live. And that's where a financial advisor, financial planner like the folks here on our team can help folks have a real sound basis for addressing that fear and coming to terms with it, and hopefully through that confidence can spend their hard-earned money more confidently and more comfortably. The next pitfall I want to share is actually one that comes at the hands of folks in our seats. We, like many investment advisory firms, financial planning firms, have some really powerful financial planning tools. I would say the ones we use are, you might say, industry leading. They're very powerful tools, and we can use those tools to help a client actually visualize a financial plan. But like with any model, any tool, the saying "garbage in, garbage out" comes to bear. And a great example of that is if you put return assumptions in there that are wildly optimistic, like many of these tools are hardwired to do, because they base forward-looking returns upon historical returns. And at a time when the rearview mirror has the best possible returns, it's usually coincident with the forward-looking period having the least optimistic returns. So that's a big problem, and it's a whole nother video I could do on the common pitfalls or misuse of financial planning tools. We like to think that we use them in the right way with the appropriate caveats and investment strategy that can bring those plans to life. I would like to turn next to talk quickly about the so-called guaranteed sources of income that many of us have: Social Security and corporate pensions. It's probably no surprise to most viewers here that the Social Security system is under strain. In fact, I'm going to go right to a report, the second in a series of 3 reports that are being worked on by the Government Accountability Office right here. This is the second in a 3-part series. The third part hasn't yet come out. But the fast facts is, in the first part, they projected that the Social Security system will be projected to be unable to pay full scheduled benefits starting in 2023. Folks, that's less than 10 years from where we are today. So even the government itself is saying loud and clear, this is a problem. So what is going to be done about this? I'm going to reference an article here on the Motley Fool because it talks about a couple solutions. So the first is, there's been talks about, basically increasing Social Security taxes on high income earners. Right now, Social Security taxes are limited to $160,000 per year of income. There are some proposals to kick in a tax above certain amounts. Let's call it $400,000, as this article talks about. There's other solutions that talk about raising the full retirement age from, say, 67 to something like 70. And there's all kinds of things, means testing. Bottom line is, I don't think for folks that are in the vicinity of retirement right now or that are collecting Social Security, I don't think that is going to be a material risk for them. I think it's higher income earners, folks that maybe have a lot of savings that will be means tested out of or phased down. In other words, people that arguably can afford to lose some Social Security benefit. And I'm not going to get into a political debate about whether it's fair or not. All to say is, I think there are some real challenges for Social Security, but for the folks that need it most, I don't assign too high a risk that it won't be there, because there'll be other solutions, I think, that come about. I want to quickly talk about corporate pensions. So this is a quarterly pension funding study, and it goes back to 1999. You can see the blue bars are where the corporate pensions in this index that Milliman follows were in surplus, meaning they had at least enough, if not more, to fund their pension obligations. So you see the blue lines is where there are surplus, and the red lines is where there's a deficit. Now you'll notice over this 20+ year period, most of the time, pensions have been in deficit. That's an oftentimes talked about pension crisis. It's only especially in bubble burstings. This was the tech bubble bursting. This is the housing bubble bursting. And just finally, with the rapid rise of the stock market in recent years to, again, bubble valuations, has this pension index gotten into surplus territory. The next chart, I think, speaks volumes, though, because it talks about from here what the scenario looks like under different rates of return scenarios. And given our views on likely rates of return, and I'll refer you back to that GMO chart on their asset class forecast that I covered earlier, in a low return scenario, this one here, pessimistic forecast, we find ourselves right back into a deficit. For folks that have corporate pensions, it's really important to understand the fundedness or lack thereof of your specific corporate pensions, and make some thoughtful conclusions. Oftentimes you have the ability to take a lump sum, which allows you to control the money, versus if it's in the corporate pension, it becomes a unsecured asset, and you become a creditor in the event of a bankruptcy. So I covered a lot of ground here today. Literally any one of these topics could be its own separate video, and I invite folks in the comments to ask questions, to make suggestions about any of these areas that you would like me or the team here at New Harbor to dive deeper into it in a future video. And again, I invite folks, if this was helpful, please feel free to share it with your friends and family. We really want to educate folks, and we're happy to have a no obligation consultation with anybody. Of course, our clients can call us anytime to talk about this kind of stuff, because it really is important. It's arguably more important than the day-to-day investment decisions we make, but obviously we make those decisions with this bigger picture in mind. So I want to thank everybody for listening, and until next time, I wish you all a wonderful day.